Well, hello and welcome to our webinar on cash balance plans, where we continue to help you, the advisor, in helping your clients save more for retirement. I am Dennis Duarte. I'm the Regional Sales Director for BPAS, and I'll be serving as your host and moderator, for today's session. As we share with our advisor partners, cash balance plans are a great vehicle for your business owner clients to save more for their retirement. So in today's session, we're going to share with you how to start and how to carry that cash balance conversation with your business owners. There is much to cover in the next hour, so let's get started. And before we start, if you should have a question you'd like to ask, please use the Q&A button at the bottom of your screen, or I'll be monitoring those questions and presenting them to the presenters. So now let's meet your presenters. Ken Perrell, why don't you tell the folks a little bit about yourself?
Welcome, everyone, and good morning or good afternoon, depending on your time zone. I hope you're all enjoying your summer. My name is Ken Perrell, and I am a Vice President with BPAS Actuarial and Pension Services. I have been with our practice and its various gyrations for 40 years now, the last 25 of which I've been working with cash balance plans. And even though I'm not an actuary, I do support our practice with consulting, plan design, plan documents, and compliance work. Rob, why don't you tell us about yourself, please?
Yeah, hi, I'm Rob Perry. I'm a Regional Sales Director with BPAS. I've been in the qualified plan since 1991 with a concentration on defined benefit plans and cash balance plans. I'm looking to get bigger deductions for our successful clients.
Wonderful. Thank you, gentlemen, for those introductions. I'm going to go off screen here shortly. So Ken, why don't you kick us off and start the webinar?
Thank you. All right, let's go to the next slide, please. So before we get started, I want to talk a little bit about who we are. BPAS is providing retirement plan services for over 50 years. Yeah, we've been in the business for 50 years. We're a subsidiary of Community Financial System, Inc., a public company that is also parent to Community Bank, which is consistently voted one of the best banks in America. BPAS provides a full gamut of retirement and employee benefit plan and trust services, including those provided by our various subsidiaries, of which our actuarial and pension services is one as well. With that, we do have our first poll question. Dennis?
Thank you, Ken. All right, the question is, what is your level of understanding of cash balance plans? Understand them very well, understand them somewhat, or understand them very little? So please take a moment to answer those questions, please. Answer that question, please. All right, looks like we're pretty much right down the middle to some degree. We have 25% who don't understand them very well, 33% understand them somewhat, and 42% understand them very little. So I think this is a good presentation for the majority of the crowd here.
That's great. Let's go to the next slide, please. Thank you. So we're often asked if it's worth saving on a pre-tax basis. And more often than not, the answer to that is yes. Here's an illustration of the power of tax-deferred compound interest. Using an annual assumed savings rate of $150,000. As you can see, the tax deferral compounding of investment earnings interest just makes the accumulation over 5, 10, 15, or 20 years that much more than if you saved on an after-tax basis, or even if you saved on a pre-tax basis, but then basically distributed at the end and paid the taxes then, which most people don't do. They defer taxes further by rolling to an IRA. So this is important, and it's a very good reason to save pre-tax. Two other advantages. It's disciplined savings that ensures that assets are actually set aside for retirement and not spent. I mean, how many of you get frustrated with clients who don't save and ultimately spend up to their means? I bet a fair number of you. And then lastly, qualified retirement plans are protected from creditors, unlike general assets. Next slide, please. Okay, so from our prior illustration, we showed savings at $150,000 a year on a tax-deferred basis. How can that be when the defined contribution limit right now is $69,000 a year, or $76,500 if you're catch-up eligible? How can you do more? Well, that's why we're here. It's easy, a cash balance plan. Next slide, please. So let's talk about the retirement program components. What typically goes into a program, especially one that we want to benefit the business owner through? Well, the first thing is going to be salary deferrals. For 2024, that's a $23,000 limit with $7,500 in catch-up if you're over age 50. Then there are typically either matching contributions or some sort of non-elective contribution. Oftentimes a safe harbor when you're dealing with small company plans. We prefer, excuse me, the 3% safe harbor non-elective as opposed to the match for various reasons, which you'll see later. Then the next component is the profit sharing piece, which is typically a new comparability allocation these days that allows you to skew the contributions. And then the last piece to the puzzle is layering on the cash balance piece, which is then cross-tested together with the profit sharing 401k plan. So, Rob, let us know why cash balance plans now are so popular.
Okay, thanks, Ken. Next slide, please. Why do people want to do cash balance plans? Cash balance plans, a lot of business owners spend a lot of their time trying to build their business, and they neglect, unfortunately, their retirement. Well, if you've had a business owner that's now in their 50s and they have not done it, they have not set up a plan, they've never done anything for retirement. If they did some type of defined contribution plan in their 50s, they'd be allowed to put in $76,500. Where in a cash balance plan, that same person may be able to put away a couple $100,000 and really catch up from what they didn't do early on while they were trying to grow their business. Also, they get the large tax deductions. Business owners, they look for the tax deductions. They want to get the write-offs, and they would like to have that money grow tax deferred. Next slide, please. Here's an example. As we just said just a minute ago, look at the 30-year-old. In a cash balance plan, a 30-year-old would be able to put away $72,000. In any type of defined contribution plan, for a 32-year-old, they would only be able to put away $69,000. Here, though, we're allowing them to put away $72,000 just in the cash balance plan alone at age 30. If they use that cash balance plan and layered it with a 401k profit sharing plan, they would also be able to put away now $141,000. And again, we're not saying that they have to, not saying that they may not need to, but if they're making money early on and they don't know whether their business is going to continue to be successful, but they know they're making it now, this is a good time to get all those tax deductions now and have all that length of time for that money to grow tax deferred. As we go straight across, we look at the 42-year-old. They're allowed, and just in the cash balance plan, to put away $130,000. That's almost double what they're allowed to put away in any type of defined contribution plan. And then we go straight across to the 54-year-old, where their maximum cash balance contribution could be up to $236,000. And I mean, it's a tremendous amount of increase over any type of defined contribution plan. Next slide, please.
Hey, Rob, there's a question. Rob,
Okay.
can you hear me?
Yes.
Oh, I'm sorry. Can you go back to the other slide, please? Just to confirm, now this is on top, these numbers you see are on top of whatever they can contribute to the 401k plan and profit sharing plan.
That
correct?
would be in addition to what they could contribute to a 401k profit sharing plan, correct?
Wonderful. And we at BPS are agnostic to where those assets are housed. We just want to do the record keeping administration. Am I correct in that as well?
That is correct.
Right. And lastly, I like to state the obvious, just in case, somebody out there doesn't know. These are assets that the advisor will be paid on to manage, as well as any of the assets in the 401k plan, correct?
Yeah, any financial advisor, they understand that when they're putting money into a 401k, how they get paid, they would get paid the same way in the money that they have under management in the cash balance plan as well.
Wonderful. Thank you.
Next slide, please. Cash balance plans are higher because it's a defined benefit plan. We are not defining the contribution. We're defining what you're going to get as a benefit at retirement. Whatever it takes to get to that benefit at retirement is what you're allowed to put away. And that's why someone that's older who has a shorter time to get to retirement is allowed to put away more money than a younger person. Right now, your annual benefit at retirement is $275,000. You can have a lump sum at retirement of $3.5 million. So again, cash balance plans allow us to just do a lot more than we can do in a 401k, profit sharing, or any type of defined contribution plan. Next slide. Similarities and differences. The similarities are that in a DC plan and a cash balance plan, you have a hypothetical account. Each participant has their own account. The accounts, they grow annually on a contribution, depending on the market, however, whether the market, whether you're making money, losing money. Hopefully, all these financial advisors, they're making, good money for their clients. They have a vesting schedule. The vesting schedule is your right to that money, the employee right to that money. It may be where it's nothing the first year, nothing the second year, then 100% the third year. The account balances are portable, so if an employee leaves, they can take that money and roll it with them to an IRA rollover account. They can take it as a lump sum, pay the taxes. That's the similarities for both plans. The differences, though, are you need an enrolled actuary to do the calculations. Everything's based on a benefit formula. You have an annuity benefit option. The employees are not affected by investment return, and the benefits can be guaranteed by the Pension Benefit Guaranty Corporation. And at this point, I think we're ready for our next poll question, Dennis.
Would help if I unmute. I believe so. So here's the question. What drew you to this webinar? I'm new to cash balance plans. I want to improve my knowledge of cash balance plans. I want to learn how to identify and sell to cash balance plan candidates or other reasons. If you take a moment to please choose your answer. Okay. Give it a couple. There we go. All right. So 11% are new to cash balance plans. 44% want to improve their knowledge of cash balance plans. 39% want to learn how to identify and sell cash balance plans. I know, Rob, you're going to talk about that in a little bit. And 6% are for other reasons. So again, it's just letting us know that we're on target with what the content of this is. So thank you.
And why don't you talk about the accumulation, the defined accumulations?
Thanks, Rob. So mechanically, how is a cash balance plan a defined benefit plan? It's because the accumulation is defined. There's not a formula that says, like a traditional defined benefit plan where you're going to get 1% times your average compensation times your years of service payable as an annuity at retirement. That's not how a cash balance plan works. Cash balance plan defines the accumulation. So let's take a look at how this works. Assume you have a business owner who has compensation that exceeded the $330,000 maximum in 2023 and the $345,000 maximum in 2024. So maximum compensation. And we have a cash balance plan for that person that defines the contribution credit as 50% of pay. And we have a plan defined fixed interest crediting rate of 4%. The account will accumulate on a defined basis as follows, and this is the promised benefit. Next slide, please. So at the beginning of 2023, obviously no balance. And because there's no beginning balance, there's no interest credit. And then the person gets 50% of $330,000 as a pay credit or contribution credit. So at the end of 2023, they have an account balance of $165,000. Then for 2024, they get 4% interest credited on that $165,000, and they get a 50% pay credit of $172,500, half of $345,000. So at the end of 2024, the accumulation is $344,100. Now this is the promised benefit in the plan. If the person were to leave at that point and was vested, that's what they could get as a lump sum. Regardless of plan's investment experience. So if in 2024, the plan investments did not earn $6,600, If they earn more or less, it doesn't matter. $344,100 is the defined accumulation at the end of 2024 in what's promised. Next slide, please. So, as Rob said earlier, what these higher contributions really mean is higher tax deferrals. So if you have, for example, a high wage earner in New York State who makes $200,000 in tax deferred savings through a retirement program, that person will lower their taxes by $74,000 in federal taxes at the top rate of 37%. And again, that's a deferral. 13,700 in New York State taxes deferred at the top rate of 6.85%, not even considering a millionaire's tax. And then remember this last piece, $1,800 in Obamacare Medicare taxes. There's that, remember, additional piece, that 0.9% tax that was added to pay for Medicare by the Obama administration back in the day. So those are the taxes that could be saved or deferred by somebody putting away a large chunk of money into a retirement plan. Next slide, please.
Ken, a question?
Yes.
Okay, so go back to that slide, please. One slide back. So this formula transcends all 50 states. There's going to be some type of tax saving regardless of what state you're in. Is that correct?
Yes, yes. So these contributions are tax deferred federal, tax deferred state. And actually one of the things we say on the next slide too is if somebody retires to a state where there's no income tax, so you see a lot of people from New York or other states retiring to the likes of Florida or Texas, or I think Tennessee also is another one where there's no state income tax. Those state tax deferrals become permanent savings.
Beautiful. Thank you.
Next slide, please. And here's some other potential tax savings. For C corporations, and a lot of like some larger medical practices or law firms are often structured as PCs taxed as C corps. So in those types of instances where the owners get bonused out at the end of the year to zero out the company profits, so you don't have double taxation, right? So it's not, so the corporation isn't paying corporate income tax and then later the person paying individual income tax when it's later distributed to them. So those types of entities will bonus out the owners at the end of the year. In those situations, instead of paying out that bonus in W-2 compensation, if they put in a retirement plan, such as again a cash balance plan, and made substantial contributions to that plan, instead of paying out those bonuses, those amounts are not subject to payroll taxes. So these people are already over the FICA wage base, but what you save are the Medicare taxes. And you save those at the combined employer and employee rate of 2.9%. And again, that's a savings, not a deferral. I'm actually in the process of putting in a plan for a large law firm where the contributions are probably going to be $4 million a year. So the 2.9% savings on the Medicare taxes on that $4 million covers all the administrative expenses of the plan and then some. So don't overlook this fact if you're marketing cash balance plans to C corporations. So what this means is that a person in this situation, in addition to the $87,700 in tax deferrals, they could have additional $7,600 in permanent tax savings. So the total tax reduction of $95,300 is almost half of that $200,000 savings. So basically, it costs them $105,000 out of pocket to save $200,000. Not bad. Next, I'm going to turn it over back to Rob.
Okay, thanks, Ken. Next slide, please. What about the existing plan? So if someone has a 401k profit sharing plan and their business has been successful and has continued to become successful, and they want to know what else can they do to get a larger tax deduction. So we say, look, let's add a cash balance plan on top of that. And again, as we looked at the chart earlier, you can see at different ages, we can put different amounts in for different business owners. 55-year-old example here, 55-year-old can make a cash balance contribution of $248,000 plus the $69,000 in their DC maximum, plus the $7,500 catch up in the 401k for a total of $324,500. Again, a lot of your business owners would have known that they could have put away $76,500, the $69,000 plus the catch-up provision in any type of 401k profit sharing plan. A lot of them do not know, though, that they can go to some type of defined benefit / cash balance plan to get that much larger tax deductible contribution. Next slide, please. Now, if we look at the 55-year-old, they have a salary of $345,000. They're able to defer $30,500, which includes the $7,500 catch-up provision. So their profit sharing with plus their 401k deferral is $76,500. $248,000 into that cash balance plan. Now we got to go to cash balance combo plan 2. That gives them the total of the $324,500 that we just talked about on the last slide. The cash balance combo 1 is if you have a professional organization and they have less than 25 employees. Then then there's a less amount that we're allowed to do, a 6% amount into the profit sharing plan portion, which then drops that amount by why you see the reduction. But otherwise, again, for a business owner, this allows them to put away a lot more money, get the larger tax write-offs for them, for the business, and that money grows on a tax-deferred basis. Ken, anything you'd like to add to that?
Yeah, just with that combo plan 1, in addition to small professional services firms, that also applies to like owner-only type plans where you have just owners, partners, and their spouses in the plan.
Right. Good point, Ken. Thanks.
So Rob,
Next.
we're looking at this slide. It's a pretty busy slide, as we've talked about before. I just want to reiterate, you would be available to talk to one of our advisor partners before they meet with a plan sponsor or a potential client to kind of walk through these numbers for clarity, correct?
Without a doubt, we're very happy, Dennis, to walk through any of these slides, to help any advisor, to make them feel very comfortable in making a presentation to their client if they wanted to present by themselves, or if they needed us to come in and work with them to help make a presentation to their clients.
I think that's one of the value adds that BPAS provides all their advisor partners, that we're willing to be with them in conversation 1. So I don't want that to go unnoticed or unsaid. So I'll let you get back to the presentation. Thank you.
All right, thank you. Next slide, please. Restrictions. Now, I'm going to tell you that for as long as I've been in this business, and unfortunately it's been a long time, but a lot of accountants have always said, we don't want to do a defined benefit plan because my client's locked in. Well, they're really not locked in. They're not locked into the contributions. Again, we're looking for a company that's been successful, is successful right now, and hopefully will be successful in the future. and that can make contributions for the next 3 to 5 years. But everybody knows, we just came out of a pandemic. The government's not going to say, knowing that a business has now suffered because of a pandemic, that you have to put these contributions in. Again, there are modifications that can be made. We can do those. It's flexible. The plan is very flexible, and we can do things to help business owners if there are problems that arise. Again, Ken, I know you're probably a little bit more technical on this than I am.
Yeah, I mean, there's, if you have bona fide business reasons for modifying plans, scaling back the contribution rates, or even, terminating it early, as long as it's a bona fide business reason and it wasn't, the plan wasn't set up for a short-term tax deferral of some windfall, where they want to put in the plan for 1 or 2 years and then, and then get rid of it. Or basically they change their mind after a couple of years and want to get rid of it. The IRS doesn't like that. But if you have a business transaction, or you're sailing along, everything's fine, and then all of a sudden you lose your largest contract and your income gets sliced in half. I mean, those are things that you can react to and adjust. The only thing that you really can't do is you can't cut back anything that's already been earned. So you can't get to the end of the year and say, oh, I can't make my contribution for this past year, but you can adjust things prospectively.
Exactly. And again, as Ken just said, you can't cut back on anything that's been earned. Again, the government, this all falls under ERISA, which is the Employee Retirement Income Security Act of 1974. The government does not care, right now, a highly compensated employee is someone making $155,000 or more. The government really doesn't worry about those type of people. They don't worry about the owners. What they want to make sure is that you're not adversely affecting the non-highly compensated employee. That's who they're looking to protect. Next slide, please. And as we just said, we're just not looking to, you're not looking to amend the plan to reduce any type of benefits that have already been earned. Where this plan, the restrictions are that as long as we're not adversely affecting the rank and file, we have play within the plan to make amendments, to do what has to be done based on the business owner's business conditions as of right now. That's what.
And Rob, that's something the advisor and the plan sponsor would collaborate with BPAS on, correct?
Yeah, and again, that's why, like, and Ken knows this. Ken knows this better than I do. When we're looking, we like to get past history. We like to see what the business has done previously. We like to see what it's doing now, so we get an idea of what we're looking at in the future. Again, there's no crystal ball to say that what we've seen early is what's going to be in the future, but we just like to get an idea that we know that the business has been successful, is currently successful, and probably will be successful going forward. And again, as Ken said, if you have some type of business where all of a sudden you lose a big contracting, we understand, and the government understands, that changes have to be made. It's just, this plan is not meant to be, as I've always said, like a yo-yo. It's not like for up and down, 200,000, 0, 200,000, 0. That's not what this plan is designed to do. And with that, I think we're going to go back to Ken.
Thanks, Rob. Next slide, please. Okay, so there are flexibilities. Like we said, the employer can terminate the plan at any time for a legitimate business reason. And there's a lot of legitimate reasons The one that's not is the, I changed my mind and I don't want it anymore. The employer can contribute any amount between the ERISA minimum required contribution and the IRS maximum deductible contribution. So the contribution amounts credited to participants are generally within this min-max range. But the employer does have flexibility where in lean years, they can maybe contribute a little bit less, or in very good years, they could contribute substantially more than the benefits that are actually being earned. That doesn't increase the benefits. What that does is that allows the employer, in essence, to fund future benefits on a current tax deductible basis. And the employer does have the ability to amend the plan as it desires, subject to what we talked about before. But if you reduce the rate of future contributions to employees, you have to give them advance notice. You can do it during the existing year, but you have to do it before the benefit is earned. So for instance, if we say to get a contribution credit in a given year, participants have to work 1,000 hours. You can amend the plan anytime up until somebody works 1,000 hours to change the formula and scale it back, freeze it, whatever you need to do. If you want to amend the plan to go the other direction, increasing the benefits, you can do that at any time during the year. Next slide, please.
Question, Ken?
Yes, sir.
So how often do plans get amended as just a general course of reference?
So we typically will talk to our clients and review the formula and their objectives on kind of a 3-year cycle. We've found that to be, acceptable and not challenged. We certainly don't want to be amending a plan every year, and really not even every other year, if possible, because we do not want the IRS to say, the employer is just doing a pattern of amendments to have a discretionary arrangement where they can manipulate their contributions up and down. So generally, we like to see at least a 3-year cycle. And a lot of times we also like to see a trend where benefits are either being amended up or amended down, as opposed to bouncing up and down. Again, we don't want to give the IRS any ammunition saying, the employer is just, manipulating their contribution on a discretionary basis through these amendments.
So what I'm hearing is that BPAS works proactively in concert with the plan sponsor and the advisor to just come together and look at the plan and see where things need to be changed, right?
Yep, absolutely. And then, and I'm not, going to say that a plan can't be amended after 2 years or 2 years after a prior amendment. I mean, there are circumstances that happen that, that warrant a plan being amended, whether it's a change in business conditions, a significant change in the covered workforce. There's various reasons that can, warrant a plan amendment. Next slide, please. So the employer may, if plan provisions permit, also manage cash flow by reducing or foregoing those discretionary profit sharing contributions for the ownership or highly compensated group. And doing that may also potentially reduce what's required to be made for non-highly compensated employees to satisfy testing. But in these arrangements, note that generally the discretion for profit sharing contributions is very limited because you have to pass testing. You usually have to satisfy your gateway requirement. So it kind of takes away some of the discretion with respect to the contributions that has to be made for the non-highly compensated group. Now, the highly compensated group, yes, you can scale those back. And also, individuals can adjust their own salary deferrals to manage their personal cash flow. So a business owner may be kind of stuck doing their cash balance contribution and a certain level of contributions for non-highly compensated, but could scale back his or her own profit sharing and salary deferrals to basically control cash flow. Next slide, please. All right. So what's the catch? Well, it's a qualified retirement plan, and as you all know, these are subject to complex IRS rules. Coverage and non-discrimination. You have to cover a non-discriminatory class or group of employees. Although oftentimes you can kind of scale back coverage in the cash balance plan because you're aggregating it with your profit sharing 401k plan to satisfy coverage. So you don't have to necessarily cover everybody in the cash balance plan, but there are minimum participation requirements. There's non-discrimination testing. Many of you are probably familiar with cross-testing for new comparability profit sharing plans. When you bring a cash balance plan to that equation, it's kind of like cross-testing on steroids. There's also maximum benefits under Internal Revenue Code section 415 on the defined contribution plan side, as well as the cash balance defined benefit side. On the cash balance side, though, the 415 limit is expressed as the maximum benefit payable at retirement. And it's these accumulations, these contributions that we back into that are attributable to that maximum benefit. Besides the IRS, you also have the Department of Labor to deal with, and that's primarily your reporting and disclosure requirements, your annual 5500 reporting, your requirement to provide summary plan descriptions to employees, and things of that nature. And then we also have what's called the PBGC, the Pension Benefit Guaranty Corporation. And unless your plan is exempt, you have to make an annual filing and pay insurance premiums to the PBGC. The PBGC is the government agency that insures private pension plans. Think of it as the FDIC of private pension plans. So if a plan terminates because a company goes bankrupt and the pension plan is underfunded, the PBGC will step in and basically guarantee those payments and fill in the gaps up to certain limits. So the PBGC premium rate is $101 per participant, plus a variable rate if the plan is underfunded. Now, as we noted before, plans that are for professional services under 25 participants or cover only owners and their spouses, those are exempt from PBGC coverage, so they do not pay premiums. Yes, Dennis.
So again, question. So I just want to, the question is that BPAS walks in tandem with the advisor and the plan sponsor through these different levels of what you discussed. Is that correct?
Yeah, I mean, we work with the plan sponsor and the advisor and, coordinate making sure that the coverage and non-discrimination testing is done and passed, that, benefits are properly limited.
Mm-hmm.
We prepare the 5500 filings and PBGC filings, and make sure that those get filed or enable the employer to file them on a timely basis.
Yeah, thank you. I just want to reiterate, sorry for stumbling over the question like that. I just wanted to reiterate with the audience that we are an active partner through this whole process, up to and including not just past the sale, but also through the management and taking care of this with the plan sponsor and the advisor. So thank you, Ken.
And with that, I think we have our last poll question, Dennis.
We do. All right, question is, are your clients and targeted prospects primarily self-employed individuals, small business owners with employees, larger companies, or a combination of the above? If you could just take a quick minute to answer that, that would be appreciated and helpful. Thank you. While they're doing that, I just want to again touch on the fact that Rob would be the primary contact along with myself for any advisor out there who wants to take a look at a cash balance plan, have a deeper discussion with it, and maybe even partner with you going into the conversation with your business owner client. All right, here are the results. 18% are self-employed individuals, 45% are small business owners with employees, right in the sweet zone. 27% are larger companies and 9% are a combination of the above. So again, right in that sweet zone.
All right, Rob, want to take us home?
All right, thanks a lot, Ken. Next slide, please. Well, here's an example of a plan design of just what we just talked about. Small business owner with few employees. We have two owners making $345,000. They're showing that they have the maximum eligible comp that we're allowed to fund towards. We have 4 employees, and they took this plan to a bank, and they asked the bank to, they wanted to start saving some money in taxes. They're successful, and this is what the bank came up and designed. They said, look, what we could do is we could do a 3% safe harbor, which will allow you to make the two owners to make the full deferral, which is the deferral plus the catch-up provision. You could put away $10,350 each to two owners, and then we had to give the rest of the employees, the 4 employees, the 3%. So we have a total of $88,330, for which the owners get 92.5%, or $81,700 of the $88,330. So I like to show at the bottom here, total tax deductible contributions, $88,330, less tax savings in a 40% tax bracket, $35,332. Total revenue owners would have received if no plan was installed and no government tax deduction. So these took the money, paid the taxes, and the two owners said, okay, this is what we have left to split up. Instead, by putting in this 401k safe harbor plan, the two owners ended up with $81,700 or $28,702. So not a bad deal for the owners, and they had and they paid their employees. Their employees got a benefit out of this. Let's go to the next slide. So now if you take the same plan and you take it to maybe some type of fund company that does profit sharing, 401k, they say, okay, now we can get a little bit more creative. Same plan, same company, same $30,500 tax deferral. Now the owners are getting $46,000 each in profit sharing. They don't get any more of a safe harbor to pass testing. The employees get $66.30. The employees get a little bit also in the profit sharing plan. Now you have the two owners getting $153,000 of $162,822, or 94% of the total dollars. And again, we say the same thing. Total tax deductible contribution, $162,822. Less tax savings at 40%, $65,129. Total owner revenue, owners would have received, if no plan installed and no government tax deduction, $97,693. Instead, by setting up this plan, the owners are getting $153, or an extra $55,307. So now we've just made this plan better than just the 401k safe harbor. Dennis, I see you got a question.
I do. I see Alan Webb has his hand up. Alan, can you unmute and ask your question, please? Alan, are you there? All right, one more time. Alan Webb, are you there? Looks like he may have fallen off. Rob, why don't you go ahead and continue? Alan, feel free to put your hand back up and we'll come back to you.
Okay, next slide, please. Now they came to BPAS, or a company that does what we do, and they said, look, can you do anything better for us? Now we said, okay, so we're going to add a cash balance plan to this. We still got the same 401k deferral, the 30,500. The owners are getting a 19,320 profit sharing. The employees are still getting the 6630 in the safe harbor, the 3%. They're getting a profit sharing contribution. They're also getting a cash balance, the employees are, but again, small. But look what the owners are getting: $322,000 and $303,000 for a total retirement for the owners of $371,820 and $352,820, or $724,640 of $745,856, or 97% of the total amount. Again, we say, and this is where the numbers, I know they look crazy, but I mean, this is what can be done though for business owners. Total tax deductible contribution, $745,856. Less tax savings at 40%, $298,342. Total revenue owners would have received if no plan was installed and no tax deduction, $447,514. By putting in this plan, by paying these employees and giving them a nice benefit, the owners are able to get $724,640, or $277,126 more than if they did nothing and paid the taxes. I tell you, all of a sudden, you're looking at those employees, and those employees, they're good employees. And the reason why I say that is because I actually had a client who said, oh, I got to give all this type of money to my employees. And then when we showed them how much more that the owners ended up, they're like, well, they're good employees. They work hard for us. So again, it just shows what can be done. And I just did something quick. You guys are financial advisors. Offer the first plan in 5 years. Offer the first one at $88,330. You would have $441,000 approximately under management. The second one, the 401k combo profit sharing plan, at $162,882, you have $814,000 under management in 5 years. Under this plan, you'd have over $3.7 million under management. So you've done two things. You've done a great job for your client, and you've also made money for yourself. Ken, anything you'd like to add to that?
Yeah, and the cash balance is a pooled account, so you're really just managing one pocket of money, and communicating with the employer about that. You're not having to deal with you're not drilling down to the participant level usually on these plans.
Right, a great point. Next slide, please. Who are the cash balance candidates? Well, we want owners that are relatively older. They're successful, they're making money, they have, after making their contributions, they're successful, they're making a lot of money so they can make the contributions and have a lot of money left over. You want business cash flow. You want to know that the business has been successful so you can keep this plan going for 3 to 5 years, as we talked about earlier. You got to understand you're going to be paying about 7.5 to 10% for the employees. But to do that, look how much in that last slide we're able to put away for the owners. And owners that are maxed out in their current defined contribution plan at $69,000 and want and need more. I'd also say any type of employee, someone that's filing a Schedule C, earns 1099 income. Ken, I know you have another candidate that works really good for this too.
Yep, yep. And also just with respect to compensation, remember that if they're an S corp, it's only W-2 compensation that counts for the owner. So if somebody is taking artificially low pay, you're going to want to ratchet up their W-2 to do this.
Right, and once it becomes K1, we can't use that money. So, and with that, I want to thank you for on behalf of Ken and I for what our presentation is, and now I'd like to turn it over to Dennis to take us home and finalize everything.
Thank you, Rob. Next slide. And this is, Rob, can you just speak to this real quick? This is
Yeah.
good.
Again, with this slide, I would just say that in the cash balance, you're looking for a more conservative investment, something that's going to make, maybe 4.5 to 6.5%. And again, the reason why this, you don't want to be in something that could be either very volatile, either high, making a lot of money, or losing a lot of money, because if it makes a lot of money, that would restrict the amount that we can put away in future years. And if it loses a lot of money, we have to then make up for that shortfall.
Great, thank you. A question did come in from Barclay. He asked if it's possible to get a copy of the presentation for future reference. The answer is absolutely yes. And that'll be a part of the after webinar email that we send out. Next slide, please. So, given the complexities of the combined cash balance 401k plan, it is advantageous to have the same provider to service both plans, but it does not have to be, correct, Ken? Correct, Rob? Cash balance plans can be standalone plans, whether the advisor has a current 401k plan or not.
Correct.
Okay. So
Yep.
next slide. I'm sorry.
Yeah, we deal with a lot of plans where BPAS is not the record keeper. It helps if we are, but we don't have to be.
Right, and again, just to close the loop on that, we fully coordinate with all providers for testing purposes and filings, correct?
Correct.
Great, thank you.
Correct.
Next slide. So as we come to a close, this is your contact information for myself and for Rob. Feel free to go to Rob directly if you have a question just about the cash balance plans, or you can come to me and we'll get you connected to Rob. We work in tandem. Rob and I work many deals together at this level. So feel free to reach out to either one of us. Happy to make time to discuss that with you. So that being said, I do see some Q&A here. That was response to the Barclay's answer. You're welcome, Barclay. All right, are there any questions? You feel free to unmic yourself, or unmute yourself, I should say, and ask any questions that you would like. While we're doing that, just wanted to go over some notes, took some quick notes. 4 key takeaways that I got out of this was by having the discussion with the about the cash balance plan with your business owner client, you're doing 2 things. 1, you're keeping any competitors out of that conversation. And 2, you're actually taking care of your client, whether they go with it or not. The whole idea is to make sure that they have valid and good information before them so they can make an informed decision. Rob, let me ask you, so if an advisor partner is looking at having this conversation and they have an interested business owner client, what's the first thing we need to get you involved?
Well, what we would do is we would get a census sheet out to the client or out to the financial advisor. And so we can then see the information, the names, date of birth, date of hire, compensation. So that way we can then come up with a proper plan design for that client.
Right, and to see if it's a viable option for them as well.
Correct.
Yeah, and that census sheet, folks, will be sent out in the thank you email that will come out after this session. Next takeaway, there's an increase in AUM for the advisor partner. I mean, that's always a good thing. I mean, that's a good way to be stickier to your client and be able to take care of them. Big takeaway, 2 really, we're very experienced. BPS as a whole is very experienced in this. Up until a recent acquisition, we had 30 actuaries on staff as employees. And some of you may not know this, but not all actuaries can do cash balance plans. And at the 30 mark, we had, I think, 8 or 9 that are certified to do that. So we have a deep bench. And with the recent acquisition of Creative Plan Designs, we've almost doubled that department. And I have to tell you, folks, we are making a big push and a big stride and a big splash into the cash balance defined benefit market because of our expertise. So please leverage us, use us, for these type of conversations. And the last takeaway is you're not alone. You're not alone. That's what we're here for. This is why we put these on. One, to inform you, so you have information. Two, to hopefully give you the key talking points you need and some information to feel confident about starting the conversation. But you don't go it alone. If you have an opportunity, you're not sure about it, reach out to myself, reach out to Rob. We'll get both of us on the phone with you and we'll start that conversation. And then if need be, we'll pull Ken in if there's something quirky about it. So this is the deep bench that BPAS offers all our advisor partners as well as our clients. And we want to thank you for being here and please take trust in that. So any questions? Let me just see here. I see none in the queue. If you have a question, I'll give you a second to unmute and ask it. Are there any questions out there? Hearing none, again, we want to thank you for being a part of this presentation. A recorded version of this session will be sent out in a thank you email, along with materials covering this presentation and ancillary materials that an advisor would need to review and kind of walk through the materials itself. I'm sorry, the cash balance plans itself. Please contact Rob or myself if you have any further questions. Lastly, as again, a continued value and benefit to the advisor community. We on September 19th, Thursday, September 19th at 10 a.m. Pacific Standard Time, we are going to hold a session on cash balance plans called Ask the Experts. And this is just going to be an open forum session. If you have questions about cash balance plan, a particular cash balance plan that you may be working on, or just want to get deeper information about a topic or a subject about the cash balance plan, please join us on September 19th at 10 a.m. Pacific Standard Time. Invitations will be sent out as we go through the latter part of August, early part of September. So please look for that. That being said, thank you again for joining us. We hope that you found this is helpful and insightful, and we appreciate your time. Thank you again and have a good day.
Thank you.
Thank you, gentlemen.